3 days ago, Apple did something that should make any rational investor rethink their position. They announced results that, at first glance, looked solid. Wall Street applauded, analysts raised price targets, and the market treated it as yet another victory for the world's most valuable company. But I was looking at different numbers. Numbers that made me sell almost 70% of my Apple position over the last few quarters. And when Warren Buffett sells 70% of his largest holding of a company he called probably the best business I know in the world, you need to pay attention to what's happening. Let me be clear about what's going on. Apple reported growing services revenue, impressive margins, and an ecosystem that seems impenetrable. But beneath that polished surface, there are cracks that most investors are ignoring because they're mesmerized by the brand, the track record, and the belief that Apple is invincible. I've spent 60 years studying business, and I've learned that no company is invincible. And when you start seeing the warning signs I'm seeing at Apple, signs that remind me of other great companies before their declines, you don't wait. Berkshire Hathaway held about 1 billion Apple shares at our peak. Today, we have approximately 300 million. We sold over $130 billion worth of stocks in 2020, and Apple represented the bulk of those sales. People ask me, Warren, why are you selling Apple? Didn't you say it was a wonderful business? And I answer, yes, it was. But businesses change, markets change, and when the price you pay becomes disconnected from the value you get, it doesn't matter how wonderful the business is. You're speculating, not investing. Here's what really concerns me. Apple is trading at multiples that assume perpetual growth, continuous innovation, and no serious competition. But the reality I'm seeing is different. iPhone sales are stagnating in mature markets. China, which represents nearly 20% of Apple's revenue, is becoming increasingly hostile with regulations, fierce local competition, and growing geopolitical tensions. Services, which everyone points to as the growth engine, are facing regulatory scrutiny across multiple continents. And the next big thing, whether it's augmented reality, autonomous cars, or any other billion-dollar bet, hasn't materialized any significant returns. Charlie Munger used to say it's better to buy a wonderful business at a fair price than a fair business at a wonderful price. Well, Apple is no longer at a fair price. It's at a price that requires everything to go perfectly for years. And in my experience, when you need perfection to justify a valuation, you're set up for disappointment. Apple may continue being a great company for decades, but that doesn't mean today's shares are a good investment. And that's why I sold. Not because Apple is broken, but because the price assumed they'll never make a mistake. And companies always make mistakes. Let me tell you a story that perfectly explains why I'm worried about Apple. In 1960, Xerox was the Apple of its time. They had revolutionary technology, absurd margins, and a brand so dominant that people used Xerox as a verb. Every office in America needed their machines. Every investor wanted their shares. The company seemed unbeatable, with a competitive moat that appeared insurmountable. And then, slowly, almost imperceptibly at first, everything began to crumble. Not because of a single catastrophic decision, but because of 1,000 small miscalculations about markets, technology, and competition. Apple today is in a surprisingly similar position. They dominate the premium smartphone market with margins that would make any CFO salivate. The iOS ecosystem keeps users locked in through an ingenious combination of hardware, software, and services. But here's the problem nobody wants to discuss. The iPhone still represents about 50% of Apple's revenue, and that product is in its mature years. People aren't upgrading every 2 years anymore. They're keeping their phones for 4, 5, sometimes 6 years because the incremental improvements simply don't justify the cost. When your main product becomes a slow replacement commodity, it doesn't matter how premium your brand is. Let's look at China, because that's where Apple's story is really unfolding in a worrying way. For years, Apple dominated the Chinese premium market. But in recent quarters, something fundamental has changed. Huawei has come back with force, offering comparable technology at competitive prices, wrapped in nationalist sentiment. Xiaomi, Oppo, and Vivo are no longer making cheap copies. They're making genuinely innovative products. And the Chinese government is, not so subtle, pushing government institutions and state-owned enterprises away from foreign devices. Apple has reported double-digit revenue declines in China across multiple recent quarters. This isn't a fluctuation. Here's what makes this particularly dangerous. Apple has built a massive supply chain in China, depending on the country not just as a market, but as a manufacturing base. They're caught between the need to please the Chinese government to maintain operations and growing pressure from Western governments to diversify away from China. Moving production to India or Vietnam isn't just flipping a switch. It's billions in capital investments, years of building expertise, and inevitable quality and logistics problems. Meanwhile, each quarter brings more uncertainty about whether China will further restrict Apple's access or if geopolitical tensions will force disruptive change. The services business that everyone points to as Apple's salvation faces its own significant headwinds. The European Union is forcing Apple to open the App Store, allowing third-party app stores and alternative payment methods. This directly attacks the 30% commission Apple charges, which has been immensely profitable. In the United States, the Department of Justice is investigating anti-competitive practices. Other countries are following suit. Apple Music, Apple TV Plus, and other services face fierce competition from established players with larger libraries and, in some cases, better prices. When you depend on services revenue to compensate for stagnant hardware, and that services revenue faces regulatory and competitive attacks, you have a serious problem. Now let's talk about something that should terrify any Apple shareholder, but is being completely ignored by most investors. Apple's next big innovation, whatever it may be, needs to generate substantial revenue in the coming years, or the growth narrative completely collapses. They've bet billions on Vision Pro, their mixed reality headset that launched with great fanfare. Early sales numbers were disappointing. The product costs $3,500. And the actual use case for regular consumers remains obscure. This reminds me of the Newton in the 90s, a technically impressive product that nobody really needed or wanted to pay for. Apple has also been talking about autonomous cars for years, spending billions on research and development. Recently, reports emerged that the project has been significantly scaled back or possibly abandoned. Think about that. They spent a decade and billions of dollars chasing a product category that never made it to market. This isn't innovation, it's wasted capital. And while Apple was chasing phantom cars and niche headsets, companies like Tesla, BYD, and Chinese manufacturers were actually building and selling electric vehicles by the millions. The window of opportunity closed, and Apple was left on the outside looking in. There's also the question of artificial intelligence, where Apple is visibly behind. While Microsoft integrated ChatGPT into its product, Google is advancing with Gemini, and Meta is investing heavily in language models. Apple has been surprisingly quiet. Siri, which was supposed to be Apple's AI advantage, has become a joke among users who compare its limited functionality with more capable assistants. Apple finally announced AI features, but they're years behind the competition. In technology, being years behind in a transformative category isn't just a temporary setback, it's potentially existential. Let me explain why this matters through simple mathematics. Apple needs to find the next $50 to $100 billion revenue source to maintain its trajectory and justify its current valuation. Services are growing, but face regulatory headwinds. The iPhone is mature. iPads and Macs are smaller businesses without explosive growth potential. Wearables like the Apple Watch are good products, but they're not needle movers in a company with $380 billion in annual revenue. So where does this growth come from? The answer bulls always give is the same. Apple will innovate. They always innovate. But hope is not an investment strategy. History is filled with technology companies that dominated one era and then failed to transition to the next. IBM dominated mainframes, but lost personal computers. Microsoft dominated PCs, but initially missed mobile devices. Nokia was the king of cell phones until the iPhone made them irrelevant overnight. BlackBerry had corporate users completely locked in until they did. The pattern is always the same. Dominance in one product category leads to complacency. Disruption happens faster than the company can adapt. And suddenly the defensible moat isn't so defensible anymore. Apple isn't immune to this dynamic just because it's Apple. Let's talk about valuation, because this is where Apple's story really becomes indefensible for rational investors. Apple is trading at a price to earnings multiple of approximately 30 times projected future earnings. For a mature technology company facing significant growth headwinds, this is extraordinarily expensive. Compare this to Apple's historical average of about 15 times earnings during most of the last decade. The market is essentially saying that today's Apple, with stagnant iPhone, China problem, and no clear next big product category, is worth double the multiple it was worth when it was growing rapidly. This doesn't make mathematical sense. Here's another way to think about it. Apple's market capitalization currently hovers around $3 trillion. That's approximately 10% of the entire U.S. GDP concentrated in a single company. To justify that valuation, Apple would need to continue growing profits at rates that historically are only achieved by much smaller companies in rapidly expanding markets. But Apple is already massive, has already deeply penetrated its core market, and faces simple mathematical limitations of scale. When you have $380 billion in annual revenue, growing 10% means finding $38 billion in new revenue. Where exactly does that come from when your main product is mature and your primary markets are saturated? Apple's free cash flow yield, which is a real measure of how much money the company generates for shareholders, is around 3% per year. Think about that. You're paying $3 trillion for a business that returns approximately $100 billion annually, but faces growing risks and shrinking growth opportunities. Meanwhile, I can buy U.S. Treasury bonds and earn 5% with no risk whatsoever. The opportunity cost math is brutal. Why would anyone accept a 3% return with significant business risk when they can earn 5% risk-free? The only answer is if you believe Apple will grow substantially. All the data I'm seeing suggests otherwise. There's also the question of share buybacks, which Apple has used aggressively to support the stock price. In recent years, Apple has spent over $500 billion buying back its own shares. At first glance, this looks great for shareholders. Fewer shares outstanding means each remaining share owns a larger slice of the company. But here's the problem. Apple is buying back shares at historically high valuations. When you spend billions buying back shares at 30 times earnings instead of 15 times, you're destroying value, not creating. That money could have been better used investing in real innovation, making strategic acquisitions, or simply returned to shareholders as dividends. What really bothers me is that Apple's valuation now depends entirely on other investors' willingness to pay even higher multiples in the future. This isn't value investing, it's greater fool theory. You're buying at $3 trillion, hoping to sell to someone for $3.5 trillion, not because fundamentals improved, but simply because you expect someone to pay more. I've spent 7 decades avoiding this kind of thinking. Charlie and I always bought businesses based on the value they create, not the price we hope others will pay. Apple at current prices violates every principle of value investing I've championed throughout my career. That's why I sold. Let me address the argument I constantly hear from Apple bulls. They say Apple has the strongest ecosystem in technology, that users are completely locked in, and that this guarantees future revenue. It's true that Apple has built a remarkable ecosystem. When you buy an iPhone, you're more likely to buy an Apple Watch, AirPods, maybe an iPad and a Mac. Everything works seamlessly together, and your data syncs across all devices. But here's what these bulls don't understand. Ecosystems aren't permanent moats. They're temporary advantages that can erode faster than you imagine when circumstances change. Technology history is filled with ecosystems that seemed impenetrable until they weren't anymore. Microsoft had everyone locked into Windows and Office in the early 2000s. Entire companies depended on Windows software. Developers built exclusively for Windows, and the switching costs seemed prohibitive. Then came cloud computing, mobile devices, and web-based applications. So it didn't matter what operating system you used, because everything was in the browser or the cloud. The Windows ecosystem didn't disappear, but its pricing power and absolute dominance evaporated. Apple faces similar risks as more services move to cloud-based platforms that work on any device. There's also the simple reality that Apple's ecosystem advantage works in both directions. It keeps users in once they're there, but it also makes it extremely difficult to attract new users from other platforms. Someone deeply invested in the Android ecosystem with years of app purchases, photos in Google Photos, and music on Spotify faces significant switching costs to come to Apple. As smartphone markets mature and growth only comes from convincing people to switch platforms, not from new users. These switching costs become a barrier for Apple too. They're stuck with their current user base growing very slowly, unable to expand significantly because all other ecosystems have created their own wall. Let's also discuss the elephant in the room about leadership and culture. Steve Jobs was a unique visionary who transformed multiple industries. He had the rare ability to see what consumers wanted before they even knew. Tim Cook is an excellent operator, someone who optimized supply chain and margins in a way Steve never could. But Cook is not a product visionary. Under his leadership, Apple has increasingly become a financial company focused on margins, share buybacks, and operational efficiency instead of revolutionary innovation. Every major Apple product, iPhone, iPad, Apple was conceptualized under Jobs. What has Cook launched? The Vision Pro that nobody's buying in services that are facing regulation. Here's what keeps me particularly cautious. Apple is increasingly behaving like a mature company focused on returning capital to shareholders instead of investing in the future. They're paying dividends, aggressively buying back shares, and optimizing for current margins instead of future positioning. This is exactly what mature companies do when they recognize they no longer have high return growth opportunities. It's what IBM did, what Microsoft did before Nadella, what Cisco did after the dot-com bubble. There's nothing wrong with being a mature company that returns capital, but you can't charge 30 times earnings for one. And it certainly isn't worth $3 trillion in market capitalization based on promises of future growth that likely will never materialize. So here we are, and I want you to understand exactly what I'm saying and what I'm not saying. I'm not saying Apple is going bankrupt tomorrow. I'm not saying they're a poorly managed company or that their products are bad. What I'm saying is something much more important for any serious investor. I'm saying that at $3 trillion in market capitalization, trading at 30 times earnings with stagnant growth and intensifying headwinds, Apple is not an investment, it's a speculation. And I don't speculate, I invest in businesses where I can understand where future value will come from and have reasonable confidence I'm paying less than it's worth. Berkshire Hathaway is now sitting on $334 billion in cash, the largest cash accumulation in our company's history. People constantly ask me why I'm not investing that money. The answer is simple. I can't find quality businesses at reasonable prices. And when I can't find good opportunities, I don't force bad investments just to put money. That money is earning 5% in Treasury bills with no risk whatsoever. That's $17 billion a year in risk-free income. I can wait patiently for real opportunities to appear. And they will appear. They always appear when the market eventually returns to reality. What concerns me isn't just Apple, but what Apple represents about the broader market. When the world's most valuable company is trading at multiples that assume perpetual growth, despite clear evidence to the contrary, when investors ignore obvious risks, because the brand is strong and the track record was good. When rationalization replaces rational analysis, you have all the marks of a market top. I saw this in 1999 with dot-com stocks. I saw it in 2006 with real estate. I've seen it in every major bubble of my 70-year career. And I'm seeing it now with technology stocks, particularly Apple. The investment decision you face isn't complicated, despite Wall Street trying to make it seem like it is. You can keep holding Apple, hoping that somehow they'll find the next big thing, that China becomes friendly again, that regulators back down, that multiples remain elevated indefinitely. Or you can recognize that when Warren Buffett sells 70% of his largest holding, when he accumulates cash at record level, when multiple valuation metrics are at levels only seen before major corrections, maybe it's time to be cautious. I'm not saying panic and sell everything tomorrow. I'm saying be rational about risk and reward. Let me close with the most important lesson Charlie Munger and I learned over decades. The biggest risk in investing isn't missing opportunity. It's investing in businesses at prices that don't make sense while facing competitors who don't need to make money. Apple at $3 trillion, facing Google, Microsoft, Chinese manufacturers, and economic reality. Doesn't make sense. It doesn't matter how great the brand is. It doesn't matter how elegant the product is. It doesn't matter how many people love their iPhones. The numbers don't work. The risks are real. And the price has assumed perfection. When you need perfection to make money, you've already lost. That's the lesson Apple is about to teach a whole new generation of investors. I'd rather not pay for that expensive education.